Two people invest the exact same $500 a month into the exact same index fund at the exact same 8%. The only difference, Alex starts at 25. Jordan waits until 35. By age 65, they end up more than $1 million apart. Same money, same fund, same return. 10 years apart, here's the whole setup. $500 a month each, 8% a year. A conservative take on the market's long-run average with dividends reinvested. Nobody picks stocks, nobody times anything. The only input that differs is the starting age. Part 1. The head start. Watch Alex's first 10 years, the decade Jordan skips. By 35, Alex has $91,173. Jordan has zero. And honestly, 91 grand after a decade doesn't look like a millionaire gap. Jordan figures, I'll catch up. Here's why that never happens. Part 2. The chase. From 35 on, they do exactly the same thing. Dollar for 30 straight years. Age 45. Alex has $294,510. Jordan, $91,473. Their deposits were identical the whole time, and the gap more than doubled anyway. Age 55. Alex, $745,180. Jordan, $294,510. Jordan isn't slow. Jordan's money is younger. Every dollar Jordan puts in, Alex invested 10 years earlier, and it has already doubled once more. Part 3. The bill. Age 65. Lock it. Alex, $1,745,504. Jordan, $745,080. The gap, $1 million, and 324 more, to be exact. Now the part that actually hurts, Jordan only skipped $60,000 of deposits. 60 grand became $1 million hole. And the eeriest detail in the whole simulation, Jordan's final balance, $745,080, is Alex's balance at 55 to the dollar. Waiting 10 years didn't delete Jordan's first decade. It deleted the last one, the decade that pays the most. Even waiting one single year costs $139,521 off the final number. The most expensive thing in this simulation isn't a fee, it's a calendar. Run your own numbers before you trust anyone else's. And subscribe for the next simulation.